First of all, thanks a lot, Prasanna. I know this is very busy market hours. So for a person like you who actually looks at a pretty large empire in ICICI Bank Global Markets, in fact, the entire global markets empire, this is really well appreciated, and really appreciate you taking the time off. So just by way of a quick introduction to the students here, Prasanna is one of the stalwarts of the Indian fixed income markets and in fact all financial markets. We kind of go back a long way ourselves. We were peers in many ways. Prasanna was an ISEC, the ICICI Securities firm, one of the first traders to make obscene amounts of money, both for the bank, for the institution, and for himself, way back 20 years ago. In fact, even before that. Right now, he's the head of global markets of ICICI Bank, and you can imagine the size of the books that he's running and the kind of client positions that he's helping handle. I will not give you his full biography. It will be circulated separately. You just Google up B. Prasanna and you'll find a whole bunch of stuff around him. Suffice to say that I have known him professionally and personally for many years now. He's also, by the way, extremely well known amongst the regulators, the Reserve Bank of India, SEBI, New Delhi. They absolutely kind of reach out to him for expert advice. He is a thought leader and he is a trusted advisor in many ways. I've heard him make several speeches in fora such as fixed income money market dealers associations and FEDI fora, etc., where some of the points that he makes, I think, are categorize him as probably the foremost expert when it comes to things like fixed income and currency markets, etc. So once again, thanks a lot, Prasanna, for being with us and being with these students here. Just a quick background: these students have been subjected to two courses by me. One is fixed income and currencies markets, and the other is derivatives and risk management. Okay, so there are two courses which went almost one after the other, and they are pretty exhausted with markets and derivatives by now. But before this, as you know, we did with Sriram as well a couple of days back, and again, this is one of the last sessions that we are having as part of this course. So, Prasanna, if I can start with a little bit about yourself, your own personal journey in your own words through this markets career. If you can tell us a little bit, that will be great to hear.
Okay. So, Anant, am I coming loud and clear to you?
Perfectly loud and clear, yeah.
So, great. So at the outset, let me just tell the students who are there attending this lecture, or rather attending your classes, I just can't say how lucky you guys are. I can tell you, I mean, Anant was really liberal in, giving me a lot of credit, but for me, Anant is actually my guru. He was actually kind enough to tell me I'm his peer. No, I'm not his peer. I'm actually his student. I have been following his career and his comments very closely. In fact, when he comes on TV, I drop everything and I see him, because sometimes when I am a little confused about things, I think Anand does a great job of giving clarity to the thoughts, the way he gathers thoughts. So
I paid him to say all this.
Sorry, what was it?
I told him I paid you to say all this. So.
Okay, yeah, sure. Yeah, and so it's a kind of fanboy moment for me to have a fireside chat with him, and I'm really hoping that I'm really going to do well in this, so that you guys are also, at the end of the day, enjoy this lecture. By the way, don't be scared that I'm, kind of praising him so much that I'm also landing up like a professor and come there and teach you guys. I don't think I have the wherewithal or the stamina to do it. I think Anant is one guy who has actually bridged the gap between the theoretician and the practitioner beautifully. I don't think there's anybody else coming anywhere close to that. And the advantage of that is a person who just looks at textbooks and gives you a lecture versus a person who has actually been there, done it. It's actually an incredible feeling. So Anant, I think thanks very much for calling me for this. And somewhere I really do think about the various Lata Venkatesh interviews that we have done together as panel boys and how she grills us. So I don't know whether you're going to grill me. Anyway, that is there. By the way, to all the students, again, apologies for doing it on video. Anand did try to bribe me into coming there, but simply did not work out. Too many kind of responsibilities here. And the advantage of, for me to do it from here is just too much. So I promised him that I will come there once more. So all you people will have to put up with me possibly once more, maybe physically that time. So I think, Anand, your question was on my personal stuff. So this is something that I have never really done, which is to speak about myself, but I will probably do it because you have asked it, and I'll do it very quickly because my journey is a pretty straightforward journey. But let me start by saying that I come from a very, very unconventional background for a person to do a career like this. I've never really spoken about my family or my family career, but I'm doing it today because Anant asked. And I come actually from a film industry background. And my father was one of the leading, film directors in the South. And I was always asked the question, I can remember, as long as I can remember, I was always asked the question, why did you leave the film industry to come to this career? And so that is something that was actually, I felt tired of answering that question. And then it took around 15, 20 years of me sticking to my career when finally people realized that, okay, this guy is possibly going to be in this career only, and let's not ask him those questions anymore. And so in the last maybe 10 years or so, I've hardly heard that question, but now I'm myself venturing to tell the kind of background you have, but more from a career perspective. So I'm a chartered accountant and a cost accountant first, and then I did my CFA after I joined office. Like I said, the road to the current position is pretty clear, straight. I have always been in ICICI Group. I worked in ISEC, like Anand said, but I shifted from corporate finance to sales, to trading bonds, and then to trading derivatives, and then to structuring. And then finally, I became the MD and CEO of ISEC PD. And then I came into the bank around 6.5 years ago. So shifted from fixed income to overall, FX as well as fixed income and sales as well. So overall, I really feel that I've been very, very lucky in whatever I've done so far. And it's not that I really, yearned for something specific. There's possibly something that I shouldn't be telling you guys because I want all of you to be aspirational. It's just that I was very lucky in whatever happened to me. And every time I think I got bored with what I was doing, I got a bigger job for me to do. So that's what has been me. So I live, breathe, and eat markets. And I can't say sleep because I don't get sleep a lot of time. So I don't sleep markets. I can't say that. So that's my journey broadly. It's been markets, and markets in the last 25 years. Back to you, Anand.
Thanks a lot, Prasanna. Your check I'll send it across to you pretty soon. So for saying all those nice things, and thank you for sharing your personal part of your life. By the way, for those who are not aware, his father is K. Balachandran, who is Dada Saab Phalke Award winner. Launched the careers of pretty much all the big shots in down south, including Kamal Hassan, including Rajnikant, including anybody you can think of. So huge name. He never mentions this. So a lot of people in the market actually don't know this.
No, actually, I didn't mention the name, Anand. You only did it.
No, I know. In fact, even in RBI, etc., I think you would get a lot more of entry right in the beginning if you had mentioned this. But he has never done this. He has never ever mentioned whose son he is in the markets. He's always stood by his own name. And by the way, he's a K. Balachandran of the markets as far as India is concerned. So let's come back to markets, Prasanna, which is, as you said, you live, breathe, and eat and sleep markets. You don't sleep markets. I'm going to start with global markets, Prasanna. So what we'll do is we'll take a bit of views of global markets, your views, domestic markets, risk management, how you see your clients managing risk, how do you manage risk, and then finally we'll come back to a little personal side, including careers and career advice, etc., if that's okay with you. So I'll start with global markets. And first of all, before we go into markets, how do you form your view about saying?
Anant, I lost you for a I lost you for a minute or lost you for 30 seconds or so. You might have to repeat the question.
No problem. The question was, Prasanna, how do you go about forming views? Because your views, by the way, are very, very sought after, even if you won't say that yourself. So how do you go about forming a view, which is something that we've discussed in class as well? Should you actually go about forming a view at all? If at all you have to, how do you go about doing that? What is your own personal style?
So I think, is it echoing?
No, it's fine here, Prasanna. Out here, it's absolutely fine.
Okay. So I think forming a view and having a clear-cut approach to what you think is going to happen to various market variables is, according to me, the first and foremost of any market professional. I have seen a lot of people constantly hedging their views. They say on the one hand and on the other hand. I have not used that kind of framework broadly. So I do take a call, willing to stick to it. And of course, with the understanding that we all start with a 50-50 probability of taking the right call. That's the way I have done it. And when you come to forming views, the way I go about doing it is, I'm not saying that's the best way, but the way I have done it is, the first is data. You need to be very clear about what is the economic data and how is it coming out. That's the first. So you need to have data with you. So when it comes to forming views on markets, it can include things like what do you expect on growth, what is the growth, what is the inflation, what is the second level inflation analysis, what is the second level growth analysis, what has happened to VOP, so on and so forth. So that data is important. Second is, like I said, analysis of the data to a second level. And sometimes always trying to guess what the next data point is going to be. It's not enough if you know everything about the last month's data. You need to have a view about where you think the next month's data or the next quarter's data is going to come from. So you have to estimate the next data. That's the second. The third is the theme of the market. I mean, if you're going to be trading markets, you're going to decide, okay, I have data, I have done an analysis, I have an estimate. But what is the market focusing on? Is it focusing on inflation or is it focusing on growth? You have to figure out what is the data that is driving the market, because market being markets and being fickle, because at the end of the day, it comprises of all of us trading. We can all decide to ditch something at some point of time and take it up at some other point of time and follow something else. So for example, in our market, sometimes oil prices determines the way bond prices, for example, moves every day morning, almost tick by tick. And there are sometimes oil does not matter, but US treasuries matter. So you need to get what is the theme of the market. Fourth, I think you need to get to what is the economic cycle, at what stage of the cycle are we in? Because the theme of the market, sometimes what happens is same data drives the market in different directions depending upon which part of the cycle you are. The classic example I will give you is oil price. Oil prices going down is broadly good for India, right? Because of India being an importer and all that. So oil moving from 40 to 30 has a totally different implication than oil going from 120 to say 100. Though percentage wise it might be same, oil going from 120 to 100 will benefit India a lot. Whereas going from 40 to 30, there will be a lot of other things which will come into play, that global oil sovereign funds which were investing in India will actually have much less money to invest in India, and so on and so forth. So at what level of the cycle we are in is the fourth most important thing. And then I would say a more, broad overall thing is, what is important is not what you think, but what you think the market thinks. Because you are trading against the next person in the market, and you have to be figuring out what is priced in. So you have to be as intelligent as the market is, and sometimes maybe as dumb as the market is, to realize what others are thinking. And one of the other points is, last points I would say is that always start with the presumption market is right. So in other words, if you have got it wrong and the market has gone the other way, no point blaming the markets and saying market is getting it wrong. You have got it wrong because you're not able to estimate the market. So always the job of a markets person is to figure out whether he's getting the market direction right, and what is it that the market is thinking, which we are not thinking when we are not getting it right. I think these are the normal ways in which I go about taking a view, Anand.
Excellent, Prasanna. That's very, very helpful and very comprehensive. In fact, I recall a few days back, and I'm going to let out a trade secret here. when the 10-year bond yield was about 760 or so. You had messaged me and you had called me and said, do you think this is looking too high and yield should come off from here because commodity prices should correct, etc., etc. Spot on. I mean, and right now, what your 10-year bond yield is 744 or something. I think I came in the way of your putting on a large position at that point in time, and I hope you don't hold it against me. No, this was very useful. So let's go into the brass tacks of global markets. What do you think is happening globally right now? So, I'm going to start with this whole point about inflation and growth that you mentioned, right? There is a fear that inflation will remain elevated for a long time, and there is it's a 40-year high in many countries, and there are fears of a recession which have already started to be baked in. So what is as far as global markets are concerned, global economics are concerned, how do you see this growth inflation dynamics play out?
So, in fact, a lot of discussions, Anant, has actually started on comparing the kind of situation that we have with something like the 1970s, which was actually characterized by really high inflation. But there are still a lot of differences between the period then when inflation really shot through the roof and consistently stayed above. Like, for example, oil prices, it actually in the 1970s increased nearly 10 times in a span of a decade. There was a wage price spiral led by, a lot of unionized labor movement at that time. Central banks were actually targeting full employment and not really targeting inflation. And if you compare it with today, what we are seeing is oil prices, yes, have gone up, but it has gone up only 2x. I mean, it is a big number, but still not comparable. And central banks are now targeting very clearly inflation, and labor force is much, less unionized compared to what it was in 70s. So while the comparison with the 70s kind of state is not really valid, but I can still say that inflation is likely to be, higher than what we have seen in, say, the last 2 to 3 decades, in the last, 20, 30 years, because of the effect that globalization had on productivity and hence had on the ability of countries to produce at much lower prices and deliver the same level of output. So I'm somehow fearing that we are now going to possibly cede a little bit of that advantage that the global economy had when there was a wave of productivity-led increase, and even including technological upgrades. But the technological development will continue to happen, I'm sure. But this move away from globalization and move towards self-production, self-determination and all that, which is what seems to have set off post the COVID as well as post the Ukraine war, seems to be a move against globalization and possibly negative from a productivity perspective. So all told, I really feel that inflation from a global perspective, like, for example, if you take the US, 2% is the target, and we have not seen 2% inflation very easily post the global financial crisis. We are seeing it at 8% now. The big question in the market is it going to go to 2 or 3 or 4? My suspicion is that we're going to see it in the 3% handle, and maybe it will still be at around 3.5 to 4% by next year. And of course, like you said, the biggest thing right now is on the growth slowdown, which has started, like you discussed, we had discussed about it around 15, 20 days ago when the oil prices and commodity prices started falling. And we had started thinking concerning, in fact, the biggest concern today is the fact that if interest rates were raised to such an extent that it kind of destroys aggregate demand, which can then lead to fall in commodity prices, which will then lead to inflation coming down. That's how this cycle looks like. It seems to look like a really, really short cycle, because the extent to which Fed is going to hike rates itself will ensure that there will be a growth slowdown fear, which will happen very soon.
Excellent, and we'll come back to some of these things that you mentioned, including the Fed hiking and the terminal rate, etc. Another factor along with inflation and growth, Prasanna, is geopolitics. It seems to be rewriting a lot of economics and expectations going forward. Unclutter this maze of what's happening geopolitically globally for us. What do you think is happening, and where do you think this heads?
Okay, so I think, Anant, I'm clearly not a foreign policy expert, so I'll have to, give you a response based on what I have read or what I've heard. And first of all, I don't think there is a clear answer as it is always is. There is never real clarity on which way countries are moving. So one argument has always been that will US, kind of cede ground to China and other countries as a foremost global power. And when you look at that kind of argument, I think one thing that you can say is surely US will continue to remain the most powerful nation. The fact that capitalism is so much, what should I say, in the blood and in the veins of people there, that the ability to scale up and scale down for every business, for every household, in reaction to any economic crisis is, I think, fabulous. I don't think any other even developed country, whether it is the Euro or the Japan area or the Euro area, whether they have that kind of an ability to react to natural economic cycles. If you go on that path further, the quality of data which comes in the US, the quality of economic data is so good that any policy which is made on the basis of that data is expected to be much better than, let's say, a country like China, where a lot of data is always under question, and even to some extent countries like India, where the revision to data of past data can be so so much more that you might wonder if policy was made on the previous data, was it really the right policy? So all these things, and then Euro area also has this peculiar problem of one monetary policy for multitude of fiscal policies and multitude of economies which have different strengths and different weaknesses. So that is why when markets react to policies made in the US, that itself ensures that the policy direction that the regulators there take, the market also helps it in the same direction and ensures that the economic cycle reacts, and then they are back to normalcy. So all these things is what will keep the US still very, very relevant in the overall thing. But however, due to geopolitics, I'm pretty sure that what we are seeing is they are ceding a little bit of that advantage that they had towards other countries like, say, China. Maybe not for the right reason, because China is possibly now, because of the fact that it's gone closer to Russia, it is not seeing eye to eye with the US, and also not least because of the fact that China itself is going to be probably the largest economy within this decade, means that, China will become more powerful. One more thing from a geopolitics side is the fact that US has, of course, lost a lot of trust that other countries had, the way they handled Afghanistan, for example, the way they even handled Ukraine for that matter. I think there is a little bit of reduction of trust. So I think that is also leading to countries looking outside of the US in terms of their own foreign policy relations. So this is what, I had to say. I mean, I will just say that US will continue to be the big brother that we all follow, but China is growing in stature purely from an economy and economic and a military standpoint.
Excellent. You started off by saying you're not an expert on foreign policy and geopolitics. I beg to disagree. Putting this together, I think it was a very good overview of growth, inflation, and geopolitics. I'm going to ask you an unfair question. Your views, therefore, distilled through all of this. Terminal US Fed policy rate in this cycle at least. 10-year US Treasury a year from now, DXY or the dollar index a year from now, which is currently what, 105-ish, close to 105. And of course, global equities. Where do you see that going as well? Especially since we've had a very terrible first half of 2022 as far as equity markets are concerned.
Right. So Anant, estimating market, all the variables that you asked for tomorrow is tough enough for me to say what's going to happen a year down the line. I will not venture into that, but I'll just try and give you a direction of where I think things are going. So on the Fed side, I think what's happening is, say a month ago, I would say that the biggest debate and the question in the market was whether Fed is going to be at 275 as a terminal rate, or whether it's going to go all the way to 375 to 4. At that time, answer was not clear. Then we had the inflation print, which came, even higher than expectations, even though people expected inflation to peak off and start coming down. And you had the Fed chair coming and telling that it's very clear that he is wanting to go after inflation and not, slow down just because the market throws its own tantrums. So I think it became somewhere clear that they will do a 375 to 4 kind of a Fed a peak rate. But what it did, I mean, that's the beauty of the market, right? And what it did is it led to a lot of fears on growth slowdown and the fear that the Fed is possibly making a policy mistake by trying to hike too aggressively. And if it hikes too aggressively, then growth is going to slow down or maybe go into a recession, as we all, people are talking about recession sometime in the next year. And we are also in a cycle where the euro area is also hiking rates, and there is a fear of growth slowdown happening there as well. There is a fear that UK, because of a lot of productivity losses, is already going to be in recession this year itself. In this background, I think commodity prices have started falling. And when we got the clarity that, yes, the Fed will go to 375 or 4, and somewhere this growth slowdown fears have again started resurfacing. And now the markets and all of us are, trying to go back and try to see whether are they going to stop at something like 3.5 or 3/4 rather than go all the way to 4%. But all in all, it is, I think, easy to say that, like I said earlier, this is going to be one of the shortest and the quickest rate cycle. I'm reasonably confident of saying that the rate hike slope of the Fed is going to be very steep. They're not going to stop themselves from hiking 75 basis points possibly in the next meeting, 50 basis points in the next 2 meetings. They'll possibly go to 3/4 or 3/2 pretty soon. Maybe even go to 4% if inflation does not come down as we expect it to come down now that commodity is falling. But if they do that, what it also means is that the market and the Fed and all the economists are going to start worrying about growth. And Fed will have to cut rates pretty soon next year. That's why I'm saying the slope of rate hike is going to be very steep, because they want to kill inflation. And the way they want to kill inflation is by killing aggregate demand. And when you kill aggregate demand, you have to have not a soft landing, but a hard landing, which in other words is a kind of a recession. And if that happens, then you know that the Fed has the ammunition to cut rates, because they have done it by, hiking rates. So you are actually going to see a whole economic cycle happening just within the next 6 months to 1 year. And that is the basic view on which I am forming a view on the US 10-year and the dollar index and the global equities. Now, given that view, now what do I think is going to happen on the US 10-year? So US 10-year is typically, effectively, it is the geometric average of the Fed rate expectations for 10 years, adjusted for demand and supply concerns. Now, if you think that you're going to hike rates quite a bit in the beginning of the year and then going to cut rates, what it means is that the long end will still not go up too much, because of the fact that the average for the entire duration will still not be on the higher side. So what it will effectively do is there will be a bearish flattening of the curve where the 2-year yield will go up, because that has to react to the 3.5, 375 possibility. But the long end, which is the 10-year, will possibly react to the rate cuts beyond that as well, and hence will not be going up much more. So my guess is, if the Fed is going to peak at around 3.5 or 375, the 10-year bond yield cannot go above 3.5. In other words, when the peak happens, the 10-year bond yield will be below that peak. The 2-year will be somewhere at around 375 or maybe 3.5 at that time. In fact, the 10-year might probably be 25 basis points below the peak. So that's the view on the USD. As far as the dollar is concerned, I think, see, when you talk about a currency, it is a relative world, right? I mean, ultimately, when you look at dollar, you have to evaluate it against the euro, evaluate it against the the Japanese currency, and evaluate it against the UK, the pound. So what is driving the dollar is actually, it's more of a dollar trend driven by a monetary policy divergence, where the Fed is able to hike rates much more. Hiking rates is positive for the currency because dollar investments become more attractive. And so because of this monetary policy divergence, euro area is not able to, ECB is not able to hike rates because of the fragmentation problem that I briefly spoke about earlier. Multiple fiscal policy, one single monetary policy. Italy and Greece under a severe problem means ECB will never be able to hike as much as the dollar. So that is advantage for the dollar. You look at Japan, they are still having inflation at 2.5%, for the rest of the economies are at 8%, and they are still doing yield curve control. Only economy which is still doing quantitative easing when the rest of the economies are all hiking and tightening. So that is disadvantage to the yen and advantage to the dollar. And when you look at it against the UK, it's the same problem. If you're expecting recession at the end of the year, I don't think the Bank of England can look at raising rates. So monetary policy divergence is all feeding towards dollar strength. Relative growth differential is also possibly, leading to dollar strength. So all in all, I do feel that the time is, it is going to be dollar strength for some more time. Now, what will reverse it is the fact that commodity prices have started falling, and there, if people start expecting that some level of rate hikes which are getting priced in is not going to happen going forward, then some of these, what I said, will reverse. In which case, the dollar, you can see money flowing back into risk assets, flowing out of the US. Whereas today, all money is flowing back into the US because nobody wants to take risk. Everybody wants to go to the safe market, which by definition is the dollar. So that's the view on the dollar. I think I did give a on one hand, on other hand kind of an argument. And last is on equities very quickly. I think all of you would have done, DCF and all that in your courses. So in your discounted cash flow valuation, there are two things which are important, right? You have the earnings growth and then you have the discounted rate. And the discounted rate is comprised of your risk-free rate and your equity risk premium. While so at the higher the discount rate is, the lower is the value of equity. So what is happening today is the PE multiple derating because of the fact that both the risk-free rate and the equity risk premium are going up from phenomenally low levels. You had 0% rate 1 year before, and you had very, very low equity risk premium. Today, both of it are going up. So that is taking a beating, and there is a derating which is happening. What is also going to happen, at least on the US side, is that earnings are going to take a hit because there is a growth slowdown which is going to happen. So both the P and the E are going to get affected, and hence you will see equity prices under stress. I still don't feel that we are still out of the woods. My basic view is that it will still be, a little difficult for equities to go up. However, like I said, if the rate cycle were to stop and Fed were not to hike, then you can see a little bit of risk on coming back into the markets. Sorry, Anant, I gave a very detailed.
This is, no, why are you sorry? I think this is brilliant. More than the students here, if I can play this to the market participants, I think they will pay me more money for this. Yeah. So thank you, Prasanna. This is absolutely clear. And as you promised, complete clarity without ifs and buts and on the one hand, on the other hand. So the way I summarize this is very, very steep rate hikes from the US, the Fed going forward because they want to kill inflation. However, that will lead to a hard landing, which means that at some stage, even rate cuts will be required as early as maybe even next year. So to that extent, if 3.5, 3.75 is your terminal Fed fund rate, your 10-year bond yield can't go beyond that, even if your 2-year bond yield does. So you do expect an inversion of some kind there coming through. Now, because of this interest rate differential between the US and the rest of the world, and the monetary policy differential and interest rate differential, you will see dollar strength continuing for a while. However, once the commodity prices come down because of recession, etc., that's when things could actually stabilize and maybe reverse as well. Right? On equity markets, I think very, very clear. Because your rates, your discounting rates are going up, you will see pain continuing. So you're not giving us any relief on that. I'm invested in equities, by the way, so I'll never forgive you for this one. But very, very clear views. Completely agree, and thank you so much for that clarity. I'm going to come to India now, Prasanna. This was global. I'm not sure how many students are really interested in the global part. Let's come to India. Same story question as far as India is concerned. Growth and inflation dynamics. How do you see that panning out in India?
1 second.
You need coffee as well. So thanks for this. But
yeah. So when it comes to India, as far as growth is concerned, I'm going to use a very commonly used nice terminology or phraseology that India is possibly the cleanest white shirt in a dirty laundry. I'm sure you would have come across a lot of people saying this. So what I basically mean is that the world is looking ugly. Every economy is going through problems, and everywhere there is a downgrade of growth. So India can't escape. but India will come out much better than the rest of the countries. Broadly, that's what it means. And why do I say that? So I have a medium-term outlook and a very, very short-term outlook. Now, obviously, the very short-term outlook is that we had a 8.4%. For example, if you have to look at numbers, our GDP growth rate expectations for India FY23 2-3 months before was 8.4% for this year. Then we had downgraded it to something like 7.4, and now we are downgraded down to 7%. And why are we doing it? Is because of the fact that we expect the high inflation to impact certain sectors of the economy, especially consumption and things like that. It will impact corporate margins, and corporate margins is something that will, get feed into GDP growth straight away. Then you have monetary tightening, which is happening both on the global side and the domestic side, and that will also have its impact with especially the SMEs now going to be borrowing at much higher rates. Maybe they were borrowing at 4% last year. Now they'll be borrowing at 8%. The smaller companies as well. That will have an impact on their growth as well. And then higher rates globally and lower global growth also means that our exports is going to, get impacted at the margin. And that means a higher current account deficit, which effectively means it's a drag on our C plus I plus X minus G kind of argument. So from all that perspective, immediate growth prospects definitely on the lower side. But why am I saying that we are the cleanest shirt? You look at some of the longer term prospects. The biggest problem India had over the last 10 years before COVID was of the twin balance sheet problems, or maybe the balance sheet problems of the corporate sector, which was highly leveraged, the balance sheet of the banking sector, which had a lot of NPA issues, and the fiscal deficit, of course, was bad, and now actually that is not something really got better right now. But I would say this twin balance sheet problems of India's corporate sector and the banking sector is now looking as healthy as ever. You would possibly have realized that in the last 1 year or so, India's corporate sector has deleveraged substantially, and debt equity ratios as well as debt service coverage ratios are much better. So the ability of the corporates to think of expansion and the ability of the corporates to come through a crisis like what we are going through right now is much better. And the banking sector is also raring to go, with a lot of capital having been raised by private sector banks as well as some public sector banks, and the fact that a lot of cleanup has happened, which basically means as these corporate sector grows and they ask for capital expansion and money from the banking system has the risk appetite to lend. In fact, banking system didn't have even the risk appetite. They might have had the money, but they never had the risk appetite. Today, both is available. So that's the first two reasons. The third is, of course, looking a little dicey today, but India has one of the largest startup ecosystem in the world. I think the third largest in terms of unicorns and soonicorns. Maybe if we had this dialogue a month ago, I would have said that there is a nice virtuous cycle, which is basically these guys raising money, investing in capex, investing in their businesses, and then able to raise more because people are discounting it over the longer term, and them generating jobs. That story has little bit got punctured a bit because of the inability of the startup ecosystem to raise money at a reasonable valuation. But I would say even that there is a blessing in disguise in everything. Maybe that it's good that correction happened. The next one is the IT and the IT sector, which has really done fabulously well. And what COVID has done is to make everybody think of cloudification, everybody think of going digital, and every small, even the Kirana store is today, setting up the ability to deliver through apps and deliver through WhatsApp and whatever be it. So everybody is actually looking at digital technologies. So that is helping our, and it's not just from India, it's from the global thing. So you see Infosys and TCS really doing a lot more projects globally. I don't think that's going to change in a hurry. There is a little bit of concern that the growth slowdown might lead to less technology spending. Yes, it is possible, but there is also the belief that this is a 5-year cycle, and the last thing which will be touched is technology spending, because that is something which helps productivity, and I don't think any corporate would want to lose on productivity at this point of time. So that is going to the services exports are going to do very well. And then the PLI manufacturing, which is, I think, a great policy that the government has started, which is to say that services has been the historical strong point for India, but let's look at something which is not done well as much, which is the manufacturing. And they have rightly, gone through the PLI route, where they are actually incentivizing manufacturing by the corporates to export, and then they give them the incentive depending upon the production that they are doing. And one estimate says that if the government were to use up their entire budget of what they are going to spend, 40 lakh crores of GDP growth is going to happen over the next, 3, 4, 5 years. And the capacity utilization at around 70 to 75% right now. And that basically means that some of the companies who are always at the higher end will already be higher than 80, 85%. And they have already started announcing capex plans. And then the last but not the least is, of course, the India's real estate cycle, which is turned after nearly 8 to 10 years. It has really turned for the good. Okay, I can't say for the good, it's at least turned for the next five years or so, because in the last 8 to 10 years, people who are not having their own houses, they're also not going and buying it because of the fear that they will have lower prices 2 months down the line. They will not have reliance on the ability of the developer to deliver the houses on time. So all of this changed when COVID happened and RERA happened. I mean, now it has become a more organized market, and the confidence level on the ability of the real estate developers increased, and people have finally bitten the bullet and said that, no, I need the house to stay. Health and hygiene are more important, and I don't want to, kind of live in somebody else's flat. And they also gone in for higher area because of the COVID related requirements that each one of their family member has in their house. So all of this put together, Anant, I think it's a long story, but the long-term growth, I genuinely believe, I mean, this is not something that I'm saying in order to, satisfy an audience or something like that. I genuinely believe that India's long-term prospects are quite bright, and we just need to see this short-term crisis behind us. I just hope and pray oil does not stay at 125 for a long period. Even if it were to fall to in the 90 to 100 range, I think India will come out of it top class.
Superb. Totally agree with you. A lot of clarity, Prasanna. Again, thank you so much for putting it in such a very organized fashion. Totally agree with all the points that you make, and safe to say that I'm not necessarily a fan of praising the government, etc. But even I would agree completely with the prognosis that you've given in terms of long-term prospects for India. So thank you so much for that complete clarity. Based on all this, before we go on to the markets, one question I did want to ask you, though, on the fundamentals. One data point which bothers me is employment in India. The fact that if you go by the periodic labor force survey, or if you go by the CMI data which comes every month, seems to indicate that while it seems like a K-shaped recovery in employment as well. I'm sure you have a tough time hiring good people in the organized sector and for traders or for IT people and so on and so forth. Any kind of skilled labor extremely difficult to hire. At the same time, on the bottom half of the pyramid, maybe the bottom 40% of the economy, there seems to be severe underemployment, unemployability, overemployment in agriculture, and that total workforce seems to be static at 40 crores for a long, long time. You mentioned PLI, you mentioned the startup ecosystem, all of which hopefully will. Do you see therefore the bottom and therefore an equitable growth in employment as well coming through? Do you see not just an overall headline number, but also bottom-up number going up?
So I think, Anand, clearly that's the challenge. So unfortunately, all of us in the financial markets look at headline numbers and look at what is the biggest driver for a lot of earnings and a lot of growth and things like that. But what we don't look at enough is how the growth is distributed between various segments of the economy. You perfectly pointed it out. There is a K-shaped recovery. In fact, that is the most used and boring answer. But unfortunately, I also have to toe the same line that it is a K-shaped recovery with the already well-off doing much better and the not so well-off not able to kind of catch up. Actually, I mean, very difficult to disagree with you on that. The IT sector, real estate sector are adding jobs. The IT sector is adding jobs at the top end of the pyramid, all very well-educated guys. Whereas the real estate sector is also adding jobs even at the bottom end of the pyramid. But I think net safe to say that the inequality is increasing. There is no doubt about that. I think we do need some kind of a government policy. Government intervention is the only way that we can bring in to increase the employment at the lower end of the pyramid. Otherwise, like you said, we will get carried away by the fact that, unfortunately, that bottom 80 or the bottom 60% maybe impact only the top 10, maybe impact only 10% or 15% of the GDP growth, whereas most of the GDP growth is actually happening in the bottom 20-30% or the top 20-30% of the workforce. So, which is why all of us tend to focus on the top 20-30 and not really look at the bottom 60-70. But I think it is the job of the government to do that, and I really hope that some kind of policy intervention does come in. I'm not able to figure out what exactly, but I think that is important.
Totally agree with you, Prasanna. Thanks for that. So, in summary, India will remain the brightest shirt in a otherwise dirty laundry. I think that's a good way of putting it. And prospects do look good for us going forward. So let's pin you down again on markets now. We've talked about economy, we've talked about employment, we've talked about lots of things within the economy. Dollar rupee is in the headlines today, breached 79, and RBI has been selling dollars, but nevertheless. So where do you see dollar rupee? Where do you see 10-year bond yields? Where do you see terminal policy rate for RBI? And of course, our own equity markets, Nifty, Sensex, etc.
Okay. So yeah, I think I'll take it in the reverse order. Maybe talk about the monetary policy first, what I expect from India before I talk about the market variables. So I think I mentioned that the rate hike slope will really be steep in the US, right? But I feel that the rate hike slope in the India will be much flatter. And by that, what I meant is if there is a difference of around 3% between the repo rate and the RBI Fed rate, the US Fed rate now, the difference is only going to narrow as we go forward with the US hiking more and more, and RBI will not be hiking as much more. So the interest rate differentials will come down. And what will happen as we go along is, as Fed is hiking steeply and India is hiking less, the impact on the currency will have to be watched. In fact, those of you following markets over the last 2-3 days might know that India's INR has already crossed 79 and is looking, everybody is talking for depreciation. And the reason is because of this differential coming down means the attractiveness of the INR becomes that much lesser. But what the RBI is possibly going to do as we go forward is, even as they don't hike as much as the Fed, they will possibly choose to use the reserves to protect a big INR depreciation. I mean, we saw them protecting the 78 to dollar for quite some time, and now they have, kind of let it gradually depreciate to 79. So maybe a gradual depreciation is in order, but they will use the reserves to kind of protect it. So what does it mean for RBI's terminal rate is that I really think that it's a no-brainer for RBI to hike till around the 5.75 to 6% range. I would rather put my finger at 6% than 5.75. And the reason I'm saying it is because RBI's own inflation projection for 4 quarters down the line is at 5.80. And the RBI's deputy governor is on record saying that he would want real rates to be positive, a slight nominal positive, while you can actually argue for even a 1% positive. But I think he has talked about a 0 to just about a positive rate, which means we are talking about a 6% inflation. So till the time we reach a 6% repo rate, so till the time we reach 6%, I don't think RBI should blink, in my opinion. But after we reach 6, which is possibly by December, I think the key thing is what is going to to be the 1 year ahead inflation expectation, which is sometime around Q4 FY24 in RBI's own analysis, and which could actually be 5% or even lower. And if RBI decides that a 1% positive real rate over expected inflation of 5% is good enough, they might want to stay at 5. This is, of course, unless, of course, assuming that the Fed stops at 3.5 or so. But if the Fed were to somehow go, I mean, all my assumptions that commodity price fall comes down and RBI can't, Fed can't hike beyond 3.5, 375 goes wrong, and the Fed starts going in the 4%, 5% handle, and then we will see obviously RBI going to 6.5 or 7. So base case 6%, a pit stop there. Look at what is the expected inflation then, and try to take a call. So in my mind, I'm playing for a 6% RBI repo rate at this point of time. But of course, they will reassess when you reach there. Now, what it does to bond markets and the whole lot of other things is, like I said, it makes the INR, since our rate hike slope is flatter, it makes our INR less attractive, but they have reserves. But I'll still have a view that the rupee will be allowed to depreciate gradually, because we can't be in a scenario when dollar keeps appreciating against all other emerging market currencies, which are our competitors from a trade perspective. We just can't allow our own currency to keep appreciating. And also bear in mind that our current account deficit is actually shifted from a positive to a negative, and have gone to a bigger, likely to go to a bigger negative in FY23. We're looking at nearly $110 billion of current account deficit this year, and a BOP deficit in the region of at least 45 billion, but maybe even as high as $60 billion. And also bear in mind that RBI has already used up maybe around, from a reserve perspective, they have lost $40 billion. And from a forward book perspective, they have lost around $20 billion as per my estimate, which also includes revaluation. So to some extent, they have been intervening and supplying dollars to ensure that the rupee doesn't depreciate too much. So they can't do this beyond a point. So if the oil were to continue to be at 110, 120 kind of a range, then it means our current account deficit is unlikely to be good, and which means that our outflows will determine the demand and supply, and hence INR has to depreciate. But RBI will, use up reserves to some extent to ensure that there is no run on the currency. So that's on the INR. As far as I think bond deals are concerned, I would say that right now what's happening is, like I said, the terminal rate expectation market is pricing in 7%. And while I think, for example, I expect our terminal rate at this point of time to not cross 6 easily. So which means there is a trade to do. I mean, there is a difference between what you're thinking and what the market is thinking. But obviously, this difference is because of an insurance value that people are, market is not a fool, right? I mean, market is a bunch of really intelligent people who already also have a reason why they have priced it at 7%. And that's the reason is there is a possibility of oil going to 150, or a possibility of oil continuing at 125 for long. And there's a possibility of the Fed going to crossing 4%. So there is an insurance value that the market has taken in a rate hiking cycle for these two eventualities. If you feel that these two eventualities are unlikely, which is that oil will not cross 125, or if Fed will not cross 375, then it is time to go long both the swap market as well as the bond market. Bond market, of course, has its own problem, which is the demand and supply. They don't add up for this year because RBI is not going to be buying open market operation. So I'm not a big fan of going big time long on bond markets at this level. But I think swap markets are looking like you can take advantage of the differential pricing between what you think is going to happen and what is priced in the market by receiving at the current level. So I don't know, Anand, did I answer all your question, or did I? Equity markets, I think. So as far as equity markets are concerned, if India is going to be the cleanest thing, we will fall less. And the fact that even a 2 lakh crore selling in the current calendar year and nearly 3 lakh crores of selling from September has not made the market or the index fall by more than 15%, means that the retail household savings have really come in to support this market, and that deserves a PE re-rating. But like I earlier said in a DCF analysis, it is both the risk-free rate and the equity risk premium, which is going up, which is putting in a natural downward pressure on equities. But as far as India is concerned, unlike the US, where even the E is a problem, the earnings is a problem, In India, I would say it's more of a P problem as of now, which is the multiple problem. I still don't think earnings is a big concern. So I would say that as long as we might not fall below something like 14,500 on the Nifty, or maybe 14,750. But if it's more of a time-based thing, I really want the US markets to stop falling. I think the biggest problem for us is when we get up every day, we see the Dow and the NASDAQ, which has fallen. NASDAQ has fallen 30% from peak, and S&P has fallen 20%. The stocks, Euro stocks has fallen by 17%. Everything has fallen substantially. So we need them to, stabilize, and then I think India will pick up. So I think India's positive bullish equity story is post-October. We need to bide our time till then. But otherwise, I will be watching out for any potential earnings impact on the corporates, which I don't think is big enough right now for me to really be worried about.
Again, brilliant, Prasanna. Again, I don't think I can summarize that, but I'll try. 6%-ish terminal rate for RBI, much slower in terms of the pace as compared to the US Fed. So you will see the differential between India's repo rate and Fed rate, Fed funds rate kind of narrow over time. To that extent, therefore, that's lower than where the markets are priced in at 7%, slightly higher than 7% at this point in time. And therefore, you see value in receiving swaps. And by the way, that means the MIBOR swaps, receiving the OIS swaps. And not so much the bonds because of supply demand issues as far as the government of India is concerned. But I guess you would, if you had to play, you would probably play the long side if there was a correction of some kind. Rupee flows are kind of against us. So gentle depreciation. RBI will be there to arrest the fall. It's already been there active to protect the rupee. I guess there's also a political economy angle involved in that, Prasanna. On equities, India will probably fall in sync with what's happening in global markets, but we'll do better than the rest of the markets. Again, your clean shirt analogy of in a dirty laundry, right? So excellent, brilliant. Yeah. One quick question on, look, many of the students here will not be trading markets other than for managing their ill-gotten wealth when they start becoming millionaires. But otherwise, they'll be managing money as a CXO or looking at other businesses and worrying about market risk when it perks up and shows up on CNBC. You're in markets and you're trading markets and you're managing risk very, very actively. For you, having a risk view is very, very critical. For a regular CXO in a IT company, or in a IT company, maybe a bad example, but in a manufacturing company or in a services company, a hospitality company, do these young people here need to worry about having a view? How do you see your clients managing currency risk, commodity risk, equity risk, interest rate risk? What are the different strategies that they adopt, and what do you recommend in case these guys become CXOs, the way they should manage risk?
So that's a great question, Anand. So I think most of what we discussed is applicable for people who actually manage portfolios and rather run prop positions. So when you join a corporate on the financial side and you grow up the ladder, so I actually feel that every financial industry or every company for that matter runs inherent risks in their balance sheet, which is interest rate risk and the FX risk. And FX risk is, of course, a much bigger risk because of the fact that imports and exports, if you are a big importer or exporter, you would definitely be having much bigger risk. So I think a corporate CXO surely needs to have a market view at every point of time. Yes, he doesn't have to bother about what's going to happen on a daily basis, but I think he does need to know at least on a 3-monthly or quarterly basis, because we do give results now, listed companies quarterly, and it's very important to figure out what is the hedge ratio that you need to do and so on and so forth. So by the way, my overall opinion for corporates is that you should always go from unhedged to hedged. If you're not in the markets business, you are in some other business, and the underlying business is what is more important for you. And you also always have to, take out the uncertainties that come to your earnings from the market variables going against you. So it's always better to hedge it so that you can also know what is the price that you have to offer to your buyers of the products that you sell to your buyers after taking into account the cost of this hedging to ensure that you have a clean spread in your business. So I do feel that you need to have hedging in place, in which typically means that you don't need to have a view. But on the other hand, I think a CXO will need to have a view because of the fact that the annual budgeting exercise and its periodic review that people do are very important exercises in all these corporates. And CXOs typically tend to rely on the macro view of the economy and the specific industry consideration when they chart out their growth path, including inorganic growth, organic growth, what is their capital expenditure, what is their borrowing plan, where interest rate risk also comes into play. So I think it is very critical for them to, think from all of this perspective and, use it for their own budgeting. What kind of products that they should be using, to hedge is something that I would say, like, one broad philosophy that I do is go from unhedged to hedged. But sometimes that can be done using linear or non-linear products. In the FX marketplace, using linear products is to use the forward rate directly, where you just lock into it. But there are also products which can be done using, collars and other things where you can, give away some upside for the sake of, taking on some downside, which you believe will not happen. There are various those kind of products. So you will be hedged in a range, and you will not be hedged only when it falls or goes up beyond a particular range, which is very, very high range, which you think is not, normally possible. So I think those kind of, things are important. Clients also, use derivative structures for synthetic borrowings, FCY or INR borrowing, to get a better price compared to outright, dollar INR funding. So imagine that somebody will have to issue a bond in the dollar bond market, and the spread at which they are borrowing has expanded because of the risk off that is happening in the market and no demand for Indian corporates. It might be better off for them to do a domestic INR borrowing and do a swap to convert it into, dollar rate, or it could be the other way around. So those kind of things are also quite important. So I think every CXO or every person who works in the corporate sector needs to, look at these aspects as well when they manage their respective treasuries.
Excellent. If there are any questions that you would like to raise, just raise your hand and shout them out to me. Anyway, these are crowdsourced questions broadly. I'm very conscious of your time, Prasanna, so I'll try and wind this down very quickly. Coming back to a personal side, we've got a lot of young students here, aspirational students. Most of them, I'm sure, want to start their own unicorns very soon. Some of them are interested in joining markets. Otherwise, like you rightly mentioned, in whichever capacity they are in, they will probably grapple with market risk of some kind, currency, interest rate, commodities, and so on and so forth. What is your broad advice for students who are considering a career in market specifically? How should they go about it? What would you suggest?
Okay, that's a very open-ended kind of a question. So I would say that so markets. So you're referring to a career in markets, right?
That's right. Career in markets. First of all, would you recommend one? Okay. Secondly, if you are recommending one, what would you suggest that they should do right now so that they get hired by people like you?
Okay. Okay, so I think what you need to do is you need to really have passion for markets. I think that word is, I just love that word, passion, because it kind of tells you what you really like and what you really want to be when you, grow older as you go into the career. And people who don't like uncertainty, it's going to be a difficult, markets is going to be a difficult job, because day in and day out, it's going to be uncertainty. And what I would say is, for people who thrive in situations where every day morning is a new situation, or every day evening is something that when you go home, you're going to have a different problem to grapple with. If you like that kind of dynamism in your career, I think that is when markets makes a lot of sense for you. And the reason I'm saying that is because there are a lot of strategies in the non-markets world which can be made at the beginning of the year which is broadly, maybe even a 5-year strategy, and broadly people, stick to it, and just it's a matter of execution after that. And there is no excitement in terms of, looking at changing it on a daily basis. I would say that a market's job, whether you're trading or whether you're hedging for your revenues, I think it's something which is so very dynamic that you need to keep questioning the basic premise of what you decided 5 minutes ago all over again. I mean, it's an exaggeration to say 5 minutes ago, but there can be times when you actually have to do it. And I mean, it's been times when I have taken a call, and then, or any of the traders would have taken a call, and then some announcement happens which then changes the entire thing. So if you are fearing uncertainty, and if you want to live in a certain world where you hate uncertainty, then markets is not your job. But then markets, if you're there, you have to live with the uncertainty. So that's one thing. Did I answer your question, or I mean, did you ask anything else?
Perfect. But what do you look for when you interview people who are entering market space, let's say?
Okay. So I think the ability to have a big picture view about where things are headed is something that is very important. Then you should have the ability to drill it down and look at the the micro aspects of the views or the things that you're looking at. And I would say it should be a nicely thought through process of all the pros and cons, and the need or the ability of people to keep questioning themselves every minute of the time. I mean, you took a decision after sitting down for 30 minutes, but in the next 1 minute, something can happen which can change that entire decision. So you need to be prepared to, keep questioning your own decisions. And first is, boss, market is right. I mean, you have to start with the assumption that market is right. If market is doing something different than what you think is going to happen, I mean, I've seen a lot of people saying market is wrong. I mean, okay, your conviction level is very high. Okay, that's very admirable. I'm not saying no, but you should be having the comfort level to question what you decided 5 minutes ago if you think the market is taking it the other way. And you have to be prepared to eat humble pie and say that, okay, maybe my view might be my view might be well reasoned, but that's not working out at this particular point of time, and maybe I should look at it slightly different. So this is an area which is very, very uncertain, market's job. And not just from a trading perspective, even when you're working as a financial controller from a hedging perspective, I think things do keep changing every day. And what you decided every day, if you want to generally use it for the next 6 months or 12 months, if you're that kind of a person, then I think markets might not be the place for you. You need to keep questioning your decision. You might have spent 2 hours just last night at 8 o'clock discussing everything and deciding a course of action, but in the morning at 8 o'clock, something happens which changes it. You might have to, be prepared to change your own assumptions. I think that's something which is very, very important.
No, brilliant, yeah. While I asked you for your views on what it takes to be a good markets person, I think over the last 60 odd minutes, you have demonstrated that amply. The knowledge that you brought in forth, the passion that you brought in, the clarity of thinking that you brought in, I think was just absolutely spectacular. I can see a YouTube video version of this going viral, at least among smart market participants. Yeah, this has been absolutely brilliant. Any questions from the students out here last minute before we let Prasanna go? Yes, please go ahead.
So you mentioned about equity markets reversing sometime in October. Could you just clarify? Could you just explain?
So did you mention something about equity markets reversing in October? And could you clarify that in case you did?
No, so it was not a clear case on, buy, wait for October and then buy equity market. It was not a buy recommendation that I gave. What I was actually saying is that what I was just saying is that the entire uncertainty of till where the Fed hikes, what will happen to the global markets, can continue for some more time. And what we are facing in our Indian markets, for example, is a lot of FII selling, right? And we are seeing that kind of compensated by DII buying, not maybe fully, but at least to a lot of extent. So I think the view there is to say that let that play through, because I don't see the FII selling, thinning down in a hurry, because what we are seeing is the reversal of the excesses of the last 2 years. And when I say last 2 years, it means a humongous amount of liquidity that has been pumped into the global markets that came into all of us and all that. So I think that's where it is. And also when there is a lot of upheaval which is happening, I mean, obviously what's happening today is some kind of an upheaval when the Fed is looking to rise 50 to 75 basis points every policy, which is every 6 weeks. Money will flow back to the mother markets, which is the US markets. And it doesn't really matter whether you are the cleanest shirt in a dirty laundry, you will still be taken to the cleaners. So to that extent, there is a lot of change. So it's, I mean, don't stick on to the timeline more often, just wait for some kind of stability. And then, look at where the markets are going to go after that. But when this entire upheaval stops, I'm reasonably sure that India will come out trumps. We also need an oil price to start coming down. We will be the worst affected if oil actually goes the other way and goes to 150. So those are the things that you need to keep in check. So don't hold me to something that I said today, make it static and then look at it in October. If you call me, I won't even take the call at that time. Yeah, so that's
two cheeky questions, Prasanna. One is, what are your best trades that you're very proud of? You had an illustrious career over 25 years in markets. Best calls, best trades that you're very proud of, and not so good calls that kind of sometimes wake you up in the night.
So I remember my not so good trades first, Anant. I think that's the first thing every trader should realize, or every portfolio manager should realize, because that is what will tell you what the mistake is. And this was a taper tantrum in 2013 where I completely screwed up. Pardon me for the language, but I didn't see it coming. And that was a time, for the benefit of students, was a time when the US Fed had used the word taper, and money was flowing out of markets. And what India had was a terrible set of fundamental data, which was not really good for an investor who's looking at it from an external perspective. I refused to, I didn't see that coming. And there was an intermittent hike by Reserve Bank of India by 3%. And I think all hell broke loose. So I didn't see that. So that was a big mistake, which was a great learning for me. In terms of best calls and other things, I would say that during COVID, or rather pre-COVID, between January and let's say March, I think India started the rate cuts in March, and globally the problem started in January. So I could see it, coming big time, and so we had, jacked up our positions much before the rate cut happened. Similarly, the demonetization time is something that I can again really hold. And in fact, I was fresh in the bank at that time, just joined from ISEC PD into the bank, and demonetization happened the next day. And I could see the impact that it will happen on a lot of us, and so accordingly acted. So these were my, kind of best calls.
Thank you so much for sharing that. You guys want to come down here for a quick photo with Prasanna before we let him go? But once
again, how is that possible? Yeah.
Oh, they're all here. So they're in the class, right? So they can just come down here. If you can come down, we'll kind of broaden the view and take a snap maybe. That will be good. Since you refuse to come down here, the amount to whatever that saying is, we'll take a snap with you here. But this was super, Prasanna. One more cheeky question before, while the students are kind of settling down. Cryptos and NFTs, etc. Would you recommend that as a personal investment for students to think about at least?
I
don't know. Can you take on? Yeah, go ahead.
Your question was on cryptos, right?
That's right. Yeah.
Yeah. So, frankly, I've never been a believer in cryptos and NFTs. Not so much NFT, but at least cryptos have never been a believer, Anant. And I actually have been feeling old and senile all this last 2 years when the rest of the community were going gaga over cryptos. I think I did really feel there was a generation gap, because I really felt that any asset where there is no stream of cash flows to, kind of support it, how can that be, a viable asset class? And it was the entire crypto rally, I would say, was built on the mistrust from currency that was created by central banks, and that also sustained for a long time during the COVID period because of the zero interest regime. You don't have any cash flows out of these these cryptos. And it all, I would say, was based on the greater fool theory that, you can buy it today and sell it tomorrow and, make up a trading profit, but there was no underlying asset class or no underlying, cash flows. But now with the interest rates reversing, I think hopefully my fears, or I don't need to really bother that I had a generation gap. Maybe for all cryptos will fall even more. I think Bitcoin has fallen nearly 60-70% from its peak. And also this thing about NFTs is, I don't know, NFTs seems to be, I think people didn't know what to do when the rates were at 0% and, try to, look at all of these things. So I'm not very sure whether in terms of adoption, whether it will really pick up as we go when the opportunity cost of, interest rates are at 3%, 3.5%. So I'm not a great fan, but there is some use case for some of these. So as long as it is limited within that, I think it's not going to be an asset class, but it's going to be having some use in terms of payment mechanism. I think that's all I have to say about that.
Oh, thanks a lot, Prasanna. Thanks a lot. The students, I think, tried to take some photographs. They managed to get my bald spot very nicely in the last match that I saw. But Prasanna, really appreciate. Yeah, I know these are active markets. Things are moving as we speak. So really appreciate you taking time out like this. I wish you could have been here and interacted directly with the students, but I'm hoping you can do that when you come here for actually interviewing and hiring some of our students from here. So I hope that happens eventually. But really appreciate. This was really a rich conversation. I think it's going to make a fantastic module for anybody any student of markets right now. The views and the clarity and the way you've thought, I think, was just absolutely brilliant. So OU1, Prasanna, thank you very much and really appreciate. Any other last question? Yeah, sorry, go ahead, Prasanna.
No, thanks a lot, Anant. I mean, it was great interacting with you. And like you said, maybe if I had come there, I think the students might have been a little bit more open to asking questions. So I think I would love to do that next time around, and wishing all the students really the very best when they really pass out.
These questions, by the way, are crowdsourced from the students, so it's okay. So these are the students' questions. But yeah, it would have been great for you to have interacted with them, but then next time, no problem at all. Thanks a lot, Prasanna. Really appreciate it.
Thank you.
All the best.
Thank you. And all the best to all your students. Yeah.